We can look back in the past to see exactly what's happened during previous market crashes, and this is where things get very interesting. In terms of how bad things could potentially get, take a look at the year 1907. This is a time when the stock market crashed 50% after the 1906 San Fransisco Earthquake, when heavy insurance payouts caused people to withdraw their gold from banks. Of course, that resulted in people cashing out, the stock market collapsed, and fun fact, but that actually led to the stock market and fiscal policies that we have today, known as the Federal Reserve. But shortly after that 50% sell-off, the stock market wound up surging 193% over the next 4 years, and that continued until the Great Depression of 1929. Back then, the issue is that banks were lending out so much money to anyone who wanted to borrow for the sake of investing because the stock market just kept going higher. Well, once the market began topping out, people started selling, panic ensued, people began withdrawing their money from the banks, and the banks couldn't afford to give people their money back because they had loaned it all out for people who wanted to invest. This led to the stock market dropping 83% over almost 3 years, with a nearly 25% unemployment rate among Americans. To make matters worse, tariffs were placed on foreign imports with the thinking that that would help drive demand for locally made products. But in actuality, that entire plan backfired and made the entire situation that much more severe. In fact, the market didn't recover for almost 20 years when World War II offered enough work for the 17 million Americans who were unemployed, at which point the stock market started going up another 14 years with a gain of 815%.